Welcome to the Rigatoni Capital podcast. It is March 18th in the morning, pre-market, Wednesday, a little gloomy outside and cold on Wall Street. Congratulations to Venezuela last night on the World Baseball Championship, beating the US. And also, I want to apologize about my podcast yesterday. Unfortunately, I am not good at podcasting with the technical stuff because I know it's not my headphones. It has to be this app I'm using that does the edits, like it cuts out the pauses, and it really made it made it sound like I was in a tunnel. And that's really disappointing because I thought it was a good podcast. We went over Nvidia and and the GTC and how Jensen Huang gave the $1 trillion estimate for cumulative 2025 through 2027. And that would have that backlog estimate is based on Rubin and Blackwell chips. And that's it. It doesn't include all the other parts of his business. And he says, well, we estimate at 500 billion. Now we're going to bump it up to 1 trillion. And he probably would have hit the 500 billion. I'm suggesting that I don't think he's going to hit 1 trillion. I think that's a stretch. And that's coming from somebody who's bullish Nvidia, the stock. So who would have thought? WTI is trading at 98.5. I guess some bearish headlines came out overnight. People are regular long-term investors are not following the Iran war story as much. We were experts for a week, and we looked to other things at this point, like the Federal Reserve. PPI came out really strong this morning when you look at an annual PPI rate. Annual rate rose 3.4% for the 12 months ended in February, the largest 12-month advance in a year. Core PPI rose about 0.5% month over month, also exceeding the forecast of 0.3, and that's because it excludes food and energy, and energy has gone up. And food has gone up too. So why do we look at the PPI? Well, we don't really as long-term investors. I don't really care because I know inflation always goes up. But the Federal Reserve allegedly looks at it, and it would make sense because it's a producer price index. So whatever manufacturers are buying, input cost wise, like eventually gets passed down to the consumer. So their inflation is out as the consumer's inflation. So anyway, I'm looking at like the NASDAQ 100 this morning. It's down almost 0.5%. So investors or algos, whoever's trading, doesn't like this. I'm very surprised to see gold continue to trade down. What do you guys think about that? I mean, of course, it's been on an historical tear, but it's interesting to see it kind of pull back here even further. I didn't think we would see the day where it kind of went through this 50-day, huh? So, and Bitcoin is pulling back significantly now. I know we had a nice bounce and it's pulling back. At this point, Bitcoin's trading on oil pricing. So oil spikes, risk assets, and Bitcoin trades down. That's just the world we live in. That's how I guess the global investors and algos want to trade this. They want to trade it based on the war, and they want to group Bitcoin as a risk asset, which I think is fine. Earnings Whispers is showing us that Lululemon came out yesterday. I'll talk about that briefly. Micron is a huge company now after their epic run, and they come out tonight with earnings. And then, of course, really nothing else here that I'm interested in. And we can touch on Alibaba Group for a minute. Really what I want to talk about today is kind of like a idea that I thought of last night for my next Substack post on Rigatoni Capital Substack. So we can talk about that briefly of kind of like how I'm thinking this through. And the topic is pretty much just like trying to think of a top title, and the title that Claude suggested was like the Cold War portfolio. And that is the fact that what is the Iran war all about? It's really about the US versus China, in my opinion. And we can kind of like title this something like the Cold War portfolio, because we always want to bring it back to investing. That's what this podcast is about. That's what Rigatoni Capital is about, long-term investing. Can we agree? It's been almost since the year 2015 that we're in a Cold War with China. Can we all agree that we are in one and it continues to go on? And it probably will continue to go on because it takes a while for these Cold Wars to end. But can we all agree that's what this is about? That's what Venezuela is about. That's what Greenland's about. That is what everything's about. That's what energy's about. That's what data center build out is about. It's all about the US versus China. And for the first time, US has a competitor in getting in other countries becoming close to this number one superpower. So it's like US has its first competitor in almost like 100 years. And this goes on every single year, and a lot of Trump's policies are based around this, and that's what the tariffs are about. When he Liberation Day, it was really all about China, trying to get China to come to the table, right? So anyway, I do want to mention something about Lululemon. This is Lululemon's stock chart since 2009. Their Q4 earnings, their revenue was only up 1% year over year. Okay. International sales was strong, but like domestic US sales not strong, in my opinion. And what happens is like when they are adding stores, so they added store count and the revenue only goes up 1% year over year, that there's a major problem with this company. And I'm going to tell you what the major problem is in a moment. First, I'm going to show you Lululemon's revenue, total revenues over an annual basis through 2016 through 2026. The revenues look fine. And you would like to see a slow trend up, but the net income looks good too over that long period of time. But then the net income kind of flattens out in 2024. Okay. And remember, this is when they're adding more stores. So in retail, what do you look at? Same store sales. I don't have that information on me, and I'm not going to spend a lot of time on something like a Lululemon. But I am going to let you know that it's really hard to be an investor in fashion type of companies, fashion retailers. Usually, as a long-term investor like myself who wants to buy and hold something, I have found myself over the last decade suggesting to stay away from something like Nike, and to stay away from something like Lululemon. And that is because fashion rotates like so sharply. It's really hard to be a buy and hold long-term investor. We can use like Berkshire Hathaway. Do they own these type of retail brands in terms of clothing, retail apparel? Do they? I don't think so. It's pretty rare. I mean, I know like Bill Ackman has dabbled with the Nike, so sometimes there's a one winner that you can have, but yeah, this is a really tough investment. And I'll tell you why Lululemon's down, in my opinion only. This is why Lululemon's down, is because what Alo Yoga apparel, what it is today, and they have some good men's stuff. I prefer Lululemon's men's stuff myself. This is Lululemon. A lot of my clothes are from Lululemon. But they have what Alo Yoga is today, which is estimated to be like a $10 billion market cap, even though it's private. We're guessing it's about $10 billion. That's what like Gemini said. And Lulu is probably like a $20 billion market cap if I were to guess. But what Alo is today is what Lululemon was, I would say, 8 to 10 years ago. So that's how fast Aloe has kind of become popular. And then I always use the best example, which is kind of like a Peter Lynch example, which that has been so overblown, the boots on the ground. investing thesis where you like go to the store and see who's popular, what store is popular. I mean, that's an overblown, overhyped type of investing thesis, of course. But I like the idea that when I was in the mall, I mean, what a difference between Alo and Lululemon, the stores. The clientele the clientele in Alo was a lot different than the clientele in Lululemon. And I'm not going to explain what I mean by that. Use your imagination and just the vibes. Aloe was like a club, and Lululemon was like it felt dead. And of course, that was one location, that was one mall. But I mean, that's what I noticed. So I wanted to go over Nvidia real quick before we kind of talk about this Cold War portfolio in terms of investing. Nvidia had the GTC keynote Monday, and then he had the analyst Q&A yesterday on March 17th, where people got to ask him questions. And again, he says he has strong confidence and visibility of $1 trillion in Blackwell plus Rubin demand and purchase orders through the end of 2027. So let's read that again. He has strong confidence and visibility of 1 trillion plus revenue in Blackwell plus Rubin demand and purchase orders through the end of 2027, significantly up from 500 billion previously stated for 2026. This figure excludes other growing product lines like Grok with a Q, the standalone CPUs, and other future offerings. So that was interesting, but that's what he said. If you listen to the GTC, he's not saying anything new here. So this was kind of like him clarifying what he was saying, and I understood it the first time I heard it when he had the big slide with the green bar chart that shows 1 trillion. What I was trying to say was when I do the math, I'm not adding up to 1 trillion. Like it feels to me like he's really over promising this. So I'm trying to think like what Wall Street analysts have wrong. That's very possible they're off by a nice chunk of revenue because it would have to be a nice chunk. We're talking over $300 billion at least, which is a cumulative revenue estimate, right? And at least it would have to be more than 300 billion because remember, this is just Blackwell and Rubin. And of course, Blackwell and Rubin is going to be the bulk majority, high percentage of all of their revenue. That we understand. But having a backlog too doesn't mean they're going to be able to hit this number in 2027. And of course, there's always an issue, geopolitical, a bottleneck issue, some kind of issue we're not aware of. And so that's the first thing, is that I'm a bull. Nvidia is my largest holding. I guess it will always be my largest holding if he's going to hit 1 trillion in just revenue for those two chips. I mean, the stock should be higher if investors believed it. If investors believed it as a group, the crowd, and believed it, if they actually believed what he was saying was true, the stock would have to trade higher. So it may take a few days for the stock to trade higher. I'm sure it's not trading higher this morning. Okay, the bigger news out of that one, because really at the end of the day, it doesn't matter. Like if he misses, the stock can do still whatever it wants. It's not like the stock's going to get smacked around too much if he doesn't hit 1 trillion in revenue, in my opinion. That's not the end of the world. It just makes us think that, unfortunately, Jensen Huang has become somebody that overpromises, and we don't want Jensen Huang to be like that. He really never has been like that. He's never been like an Elon Musk that overpromises and underdelivers, so that would kind of be disappointing. But either way, what we want to say, that's the most important part about yesterday's Q&A with Jensen Huang, was the capital allocation part. Because at the end of the day, capital allocation is all that matters as a long-term investor, right? He expects to allocate approximately 50% of free cash flow to stock repurchases and dividends, with potential for more given the plus sign and demand visibility. This is the most important part, like I say, and the stock could react strongly on this more than the $1 trillion revenue estimate. The problem is long-term investors like myself don't want dividends. We don't want dividends because it's a taxable event, and it makes us feel like it's less of a growth company, at least if they decrease the float, that makes us, it's not a taxable event. So definitely more interested in share repurchases than dividends. I don't need Nvidia to be a big dividend payout type of stock. Retail customers, retail shareholders, I guess, like dividends. Some of them don't. That's not the point. The point is it's a taxable event. Okay. So some people don't care. Now, to say about shrinking the float real quick, if the dividends get spit out to investors, long-term investors like myself, a big chunk of those dividends get repurchase the stock anyway. So remember that the drip will be turned on for a lot of investors, and so it'll automatically the next day or two will buy the dividends will buy your shares that you already own. I mean, they'll buy new shares so you're adding on to your position there automatically with the dividends. But and then the last point of the Q&A is he talks about gross margins sustained by consistently delivering significantly more value, tokens per second per watt, which with each new generation enabling customers to justify higher prices for superior performance. I don't really understand what he means by this. Not an expert on every little single thing here. Gross margins is always a big story because the story doesn't work if their margins get eaten away. The Nvidia story doesn't work as a shareholder, as a long-term investor. It doesn't work if those gross margins keep coming down, which he's trying to say that they won't. They won't come down. And then, of course, somebody said he's obsessed with OpenClaw and all that stuff. Like, yeah, I'm sure he is. It's a very fascinating, interesting technology that you can have something autonomous running 24/7. So yeah, that's about it that I wanted to talk about. And then what I've been doing is I have been showing you like a post I did this time last year, which is embarrassing because when I look back at these posts on Substack, I see how my writing has evolved in the last 12 months. It's incredible to see how I used to write versus how I write now. It's night and day. I mean, look, I was using bullet points, and it's very odd to see that writing schedule that type of writing. I don't use bullet points at all anymore. More of like a deep dive type of writer. I don't know how to explain it, but I write like full paragraphs, and it's just interesting to see the format here. And the post this time last year, March 16th, was called "The Headlines Got It Wrong: What 2018's Trade War Panic Tells Us About 2025's Market." So I'm trying to explain, like, this is when the market was selling off a little bit more sharper now because of the tariff war that was starting and Trump pretty much putting out like this was before Liberation Day, but it was leading up to it. So the market's already sniffed out and they knew what was coming. And like I said, in 2018, March 2018, the headlines were trade wars will tank the economy, Trump's tariffs will destroy jobs, the WTO is dead, and the US is isolating itself. And then you fast forward and that was like completely off. That wasn't really correct, right? And then I kind of try to say, like, back this time last year, what really mattered was like Nvidia. It wasn't even about tariffs. Nvidia is such a strong piece of the puzzle when it comes to the US-China trade war. And that reminds me that we should also mention that this is really important. Nvidia says it's restarting production of AI chips for sale in China. The reason the market doesn't trade up on this, and Josh Brown had noticed this probably yesterday, was because of the starts and stops. The starts and stops. Every time we get a headline like this, we get a headline 3 days later that says China's not going to allow this. So there is this back and forth for these H200s. If it actually works out, this revenue is not accounted for in these type of the earnings you'll get from this, and the stock is not accounted for in the stock price because it's not even in Jensen Huang's forecast, and it shouldn't be in anyone's forecast. So it would just be like icing on the cake, and that would have to be part of the story that gets it like to $250 a share quicker. I think we can all agree. Well, in my opinion, I think Nvidia is going to hit 250 per share within the next 12 months at least. But like something like this allows it to happen faster because China is such a large customer. Okay, so real quick, we'll get over this, but it's just interesting to go back, look at the Substack I wrote a year before, and how I was kind of like saying, like, don't be fooled. We went through this in 2018. Remember, my theme here at Rigatoni Capital is long-term investors always forget, including myself. And short-term investors have no memory. But even long-term investors have kind of a good memory, but they have to be reminded. And reminding yourself on what exactly occurred in the 2018 Trump tariff war with China versus today, I saw a lot of similarities. And I was trying to just tell you, like, don't trade on this, or definitely don't be too concerned about this. It'll get itself worked out. US is not going to die forever. And then I was really early to that. And then on Liberation Day, now that myself and a large retail investor base bought that dip because they weren't fooled. And I'm not talking about taco. I'm talking about just the fact that the media, the financial media, overblew this tariff war. And they will continue to overblow it. They're obsessed with tariffs. And at the end of the day, they are just one small piece of the puzzle. It's really not that big of a deal. It's really not that big of a deal. Economists think it is, and I would disagree. Of course, it affects everybody. I'm just saying it's just not that big of a deal. And we can see in March 2026, which we are in, cash levels. So this is kind of like retail cash levels, I guess. I'm not too sure. It says Bank of America FMS average cash levels. Cash levels jumped from 4.3% from 3.4%. Biggest monthly increase since COVID. So the whole point of this Bank of America Global Fund Manager Survey is trying to explain to you how retail is now has a large cash pile, and I don't think it's that big of a deal either, to be honest with you. A post from Brian Sozzi I found last night shows you so many Nvidia chips are going to be planted in these robots through 2050. Yeah, I think this is a big story because we want to know the picks and shovels investing thesis of Nvidia. The picks and shovels seems to be that, according to this, which is by Morgan Stanley's research estimates, he thinks that Nvidia chips, but this isn't claiming it's Nvidia chips. It's just claiming that chips. It's just claiming that chips. It says robot revenue. Yeah, so we would need a little more clarification, sir, Brian. I don't know if this really means Nvidia chips now that I'm looking at it, guys. But anyway, look at the amount of chips that humanoids need. That's crazy. Humanoids by the year 2040s, and I mean, it is a big chunk. This humanoid robot story, if it plays out, the picks and shovels that need the type of chips that need to go inside of these humanoids, that's where the money is. It's not in the humanoid itself, in my opinion. I guess it could be, but someone that is investing in this arena should really be trying to figure out what are the chips that are going to go into the humanoids. And if it's like Nvidia or something, that's huge. And then I'm less interested in autonomous vehicles, but you can see that's a huge chunk as well. And then there is professional service robots. And that's also, let's kind of group that in with humanoids right now, because I don't really know what professional service robots are. What I think is really wrong on this estimate chart is I think small drones is on here. Okay, that's fine. But industrial robots, I feel like is too small. It's too small of the pie. I would think that industrial robots would be a much larger piece of the pie. Okay, so this is a really cool chart. Brian Sozzi posted it. He says so many Nvidia chips are going to be planted in these robots through 2050. We don't know that for sure, but we know that Lam Research, these type of chip companies, if you can figure out Micron, whatever, like if you can figure out which chips will be implanted in these robots, like the humanoid physical robot space, I think that's where the investment is. versus being distracted by the humanoid and trying to pick which humanoid is the future that's going to fold your clothes in your bedroom. Like, I think that's a distraction right now. I think trying to figure out like what can be mass deployed and input into the humanoids. That's where I think the investment is. I was going to play this video of Jensen Huang literally talking and explaining how he'll spend 50% of his free cash flow in 2026 on share buybacks, but I didn't, and dividends, but we don't have time. I don't really think we have time to go over the main point of my podcast this morning. And I think I kind of want to hide some of it too, because I kind of want to make it a Substack post, possibly. But again, it was investing through the US China Cold War. And yeah, I think I might skip it and kind of cut this podcast quick. We can talk about it maybe briefly tomorrow if the news is slower. And then tomorrow would be Thursday morning. And then Friday morning, I'll post a podcast with myself and three other gentlemen that are on Substack. And their expertise seems to be like energy and powering the data center and how we're going to get this type of energy to power the data centers. This all comes down to energy at the end of the day when it comes to the AI story, the AI infrastructure rollout. It eventually always comes back to energy. So I'm going to talk to those three guys on Thursday evening, and I'll post that on Friday. Okay. And we'll touch on this, my idea about investing, the Cold War portfolio type of investment idea I have. The idea is I'll break it down really easy for you without opening up Claude. And this was inspired by Lit Nomad. I think his name's Tyler on YouTube, and he's the best. He's a ex Wall Street quant trader, and I think he retired, and now he just kind of vlogs and chills. In my opinion, I don't know what he actually does, and he likes to travel. I'm guessing Asia countries, and anyway, he has become a philosopher. He's a young guy. And his idea is like, look, the US stock market returns 8 to 10% every year. And if we are in a Cold War, which we are, we can all agree with China, does that mean that the S&P will return less if China wins the Cold War eventually? And does that mean you need exposure to Chinese stocks? And he explains like, no. Yeah, the S&P might return less, but you definitely don't need to own Chinese stocks unless you want to kind of speculate and maybe pick like Alibaba or some of the big like Huawei or Tencent, like some of the big tech giants over there. If they're going to win the AI arms race in China, maybe that's your play. But my opinion is like stay away from the Chinese equities. And even if you look at Chinese investors and global investors in that part of the hemisphere, most of those investors don't find Chinese equities safe. Like most of the people, a lot of the people that own Chinese stocks are from the US. It's not even their own population. What Chinese people think are safe investments to them are more like this idea of real estate because they think that is more safe from the autocracy of China and the CCP, like something physical like gold or any kind of physical hard asset which can't be diluted overnight, or capturing Jack Ma overnight. Like there's a big difference in something that says you own a share of a company that's on paper versus something like gold, for example, or real estate like your house. So anyway, that was the kind of the idea I had. And then it kind of goes back to Bitcoin, how I do believe that Bitcoin is a winner in the long term if people can actually wrap their head around the technology. It's very clear that people cannot wrap their head around the technology. And I can understand that because it took me a really long time to wrap my head around the purpose of Bitcoin and the idea of Bitcoin. And Bitcoin is like democratic in a way. It's like the opposite of the Chinese Communist Party. If you could think of something opposite, it would be an autocracy. It would be anti-freedom. It would be anti-democratic. And Bitcoin has all of those characteristics because it's like the first time you can own own something and own your own property in your head, and really, and no government should be able to take that from you. So yeah, it was a post, and I brainstormed throughout the week, and then hopefully by Sunday night it's written, and I'll post it on Monday. And no, it's really interesting listening to Lit Nomad on YouTube, and I wish I could have him on this podcast as like a guest, because I think we see eye to eye on practically most things, and but like I kind of disagree with a few different things on what he had mentioned, and I don't even know if he is aware of the Freedom 100 Emerging Markets ETF, the FRDM ticker. Maybe he would think that would be a wise investment to allocate to if I had an opportunity to talk to him one on one. And I might try to reach out to him and see what he has to say about it. But yeah, so anyway, thank you guys for watching, and we'll talk about that a little bit later. And what else? My suggestion is to at least get on Substack and try to figure out what, if you're a long-term investor, check out Substack, because Substack is the best place to get deep dive type of investing ideas, in my opinion. I think it's better than everywhere. And like the social media part of Substack is really good too. And man, it's night and day versus something like Twitter, X Twitter. It's definitely like Twitter X is the mainstream kind of spammy, everything that's wrong about the world, and then Substack is like actual genuine people that care about investing and want to support each other. So a whole different world. You can find Rigatoni Capital on Substack, on YouTube, on Spotify. Thank you guys. Have a great day. Bye.